Stocks sprinted to more records today in a broad rally that pushed the Dow and the S&P 500 to fresh all-time closing highs. The Nasdaq, for its part, closed at its highest level in 12 years. Traders were cheered, among other things, by better-than-expected import data from China. That suggests that demand in the world's second-largest economy remains strong. The blue-chip Dow index surged 129 points, closing at a record 14,802, with 15,000 Dow in sight now. And the S&P was up 59 points, nearly 2%, fueled by sizable gains in some big tech companies. And the S&P 500 index up 19 points, and it hit a new record high, 1587.
Now, another factor fueling that rally, some encouraging news from the Federal Reserve. The notes from the Fed's latest meeting showed that most policymakers want to continue buying billions in bonds every month to continue stimulating the economy, at least through the end of this year. Those minutes were accidentally leaked 5 hours ahead of time and came out before the stock market opened today, giving investors confidence to snap up stocks. Well, the Fed may have helped drive today's gains, but does the rally have staying power? We turn to some market pros for answers. Show me the money. Investors have been looking for big returns on their money, and it looks like they're finding them with stocks and less so with bonds. And the more the stock averages go up and hit new records, the more courage investors have to put stocks in their portfolios. The urge to buy is so strong that investors have been shrugging off bad economic news about the job market, as well as political tensions in North Korea. But despite all the new milestones on Wall Street, some market pros would still like to see the rally spread out.
In all of the upward move and all the new record highs, there is a sense of seeking safety and protection. It's kind of a dichotomy. If you look at the other markets around the globe, they're not all participating in the same manner. They've decided to almost begin to take the summer off already, and it's been the S&P and been the Dow Jones. That's encouraging. They're the two drivers here, but you'd really like to see it broaden out a bit.
Healthcare stocks, consumer staples, and utilities are popular with investors. They're also loading up on defensive names and big blue chips that pay dividends. Technology, materials, and energy are the underperformers and have been lagging the market.
We've seen in the first few months of this year, we have seen much more interest among mutual fund buyers to buy into equity funds. I think we're also seeing that. We're still seeing that. But also I think some institutions are buying in. The one thing that all this QE has done is it's made it a sort of a TINA market. There is no alternative to being overweight equities market.
As long as money managers dole out that kind of advice, it looks like we'll be seeing more records in the markets.